Xhanti Payi has joined us. He's an economist at Nascence Research, and he's going to give us some analysis on some of these issues. Xhanti, thank you for joining us. Clive has made some pretty big statements as well before you arrived, but let's get your sense from an economist's point of view. What on earth is going on?
Look, I think, the recovery has been fragile for quite a while, and I think a lot of people had been saying, one of the things that we've been watching, especially in the US, is the idea of, especially looking at the central bank, right? They've been looking at jobs in particular, but production data, and one of the things that wasn't really coming back was that since, the US, long-term production level. So, and we've been hoping, and I think some of the data is suggesting perhaps a different kind of picture in terms of what's going on there. And we can't run away from the fact that between China and the US, they have still been, part of about 60% of global production, exports, or growth in general. And so in a sense, that's the two places that we've been watching quite a lot. And I think they do feed off each other quite important.
So we've been hearing the story that China is slowing down. We know that the World Bank has confirmed it and other sources have confirmed it. But if we're seeing markets doing this, have we underestimated the weakness of the Chinese economy?
I think one of the things that's worrying is that I think the Chinese themselves have confirmed it. Now, for the longest time, people thought, and it was always natural that China would slow down in some sense, right? We couldn't grow at 10% forever.
Yeah.
So that slowdown was understood to come. And when it was happening, people thought, well, it might be bad. And then the Chinese now, the way in which they are maneuvering in the market system and the currency suggests that they're quite as worried as we are in terms of what's going on. And I think that is spooking people quite a bit.
Let's bring you in on that, Clive, because we did see the devaluation of the yuan. I think that was about last week. And today we're having this massive sell-off. What should we be bracing ourselves for? I mean, what kind of intervention should we be expecting from the Chinese? Because they haven't been too shy to get into the markets and try to pull in some stability when necessary.
And maybe that's why the market is scared, is what the Chinese do. Because their response is like, all right, we're weakening the yuan. All right, wait a minute, let's hold the stock. And I think one day this week they stopped for 15 minutes after they started trading. They said no more trading. So that's not a rational response to when you are going through a crisis. You have to have models in place. And Xhanti is quite correct. The problem came in when they themselves said we are planning a slowdown. And we are well prepared for this, and this is what's going to happen. And so we've put all the right things. We are converting from this external investment model. We're going into a consumer-based, and so this is going to be a smooth ride into it. It was not anything close to smooth. And the response from them is that they're panicking because they think that obviously they've exposed themselves far too much onto not just Africa, Brazil, the emerging markets, but to America, who they have the most debt against China themselves. So whatever happens in China affects the mother of all economies and everybody that's catching the cold.
And the key word, of course, being a panic. We are seeing our investors panicking. We're going to cross over to international programming now. Just a reminder that all S&P sectors are down. The Dow Jones is down in excess of 433 points. Let's pick up on the international conversation.
Don't bear well for that hope. On the other hand, they're at the early stage in the venture markets. Life is good. Series A, Series B companies are doing fine. They're less impacted by these kinds of trends. I'd say the underlying good news, if you're sitting in my seat looking for more companies to put talent into or invest in and maybe even operate, the companies at the growth stage that were really overvalued for a while, I'd say almost for a couple of years now, those multiples now in the private market are starting to compress. We've heard about down rounds, we've heard about that growth end of the market. So even if you're not a unicorn per se, there are a lot of good companies out there that are going to need to raise capital, and the multiples are coming down. So if you're in the investment side, pre-IPO, growth stage, I think pricing is starting to come back into trend. So that's the sort of silver lining inside all of this if you're in the private side of the world.
And what about the public, Scott? I mean, you will keep one eye on that. That's part of your job, I guess, probably part of how you're investing, to keep one eye on the public markets. What do you think about the valuations there? Clearly, a lot of the big momentum names, I mean, Amazon, Google, or Alphabet, who did so well last year, even they have suffered from profit-taking recently. How do you view those bigger tech stocks?
I mean, I think you got to take a long view on this. Companies that have more exposure outside the U.S. are clearly getting impacted. I don't quite understand why so much of this has started to hit the tech sector as hard as it has, other than they have global exposure. But I think Look, we're at the up end of the top end of a cycle of many years now. A lot of people, and I was with Bill Gurley and others for quite a while, Bill Gurley Benchmark, who have been saying for quite a while that this sort of had to happen at some point. Far be it from me to try to predict market bottoms or exact trading trends right now, but I think that we're going to say the top end of the market probably was hit for a while. I think IPOs are going to be in trouble. That's going to hurt. The growth side of the market for quite a while until we start to see that window open up again.
You make an important point, which
and
is
as we've seen, of course, that negativity in the market, on the global markets, continuing quite strongly. Let's bring it back home, because it is Friday evening, but we're going to get a really fresh sense of this when the markets or the JSE opens on Monday. Implications for South Africa, the weakness that we're seeing on the global front.
Look, I mean, there's no doubt we've been taking cue from China, we've been taking cue from the US, so certainly this is definitely coming for us. One of the interesting things about this is exactly the point around how, we've been framed as an emerging market, and how we've been framed in terms of actually our own participation. I mean, we were very excited today, right, about what was going on with the new listing of, is it
AB InBev?
Yeah, InBev. And it was quite an exciting moment, right? And we're thinking, things are happening in our own economy and all of that, but certainly now we have to take all the cue from what is happening in global markets in terms of the way actually we have to, respond. And very little can come of the South African market to make a difference.
Guys, I want us to talk about Brent crude. I mean, below $30 per barrel. We've been saying all week it would be ludicrous for it to hit 15. Some analysts are saying that it's headed to 15. But on a day like this, Clive, you start looking at the crude market a little bit differently, don't you?
26.19. That's the last screen I saw just before the JSE shut, and I still couldn't believe it. I was like, "What? No, wait, there must have been a mistake. There's a 3 missing." Oh no, it's not. It's $26 per barrel. What is the issue here? The issue is that it is a sign when economies are not in sync. So, for example, the US wants to dictate pricing, yet the majority of the oil comes from the Middle East, which is OPEC. And they're saying, the argument is that for a bargain, you can even get away with $10 a barrel. You can get away with it. So it's not suiting well for the guys who own the companies, who sit in the United States.
Right.
But there's nothing wrong in Iraq and in Saudi Arabia, things are still fine. They're still buying the $2-3 million cars. They don't mind. So the problem here, the significant issue here is, how does that affect the rest of the oil market, the guys that have actually invested? It affects them because the price, perhaps maybe for the first time we realize, has been overpriced. And maybe now the reality is for us to say, well, what is the true price for Brent crude? Should it be set in dollar terms, which is the denominator that actually is utilized to extract the goods from the ground, or should we be using where it actually comes from? And that question needs to be answered. It's going to be answered even in some of the countries that produce other resources, like platinum, like gold, like diamonds. Who should be setting that price?
But we're not hearing the likes of Nigeria coming up with that or supporting the argument and saying, hey, maybe let's denominate this in the Naira. Because my thing that I don't understand is how Nigeria continues to be part of OPEC, because this means that their revenue streams are drying up. At 26.19, this can't be good news for the economy.
Well, I mean, they did enjoy the good times. Remember, having priced dollars, at the time they were enjoying the good times, and I think they didn't think that we would get to where we are. And obviously OPEC had been very strategic in the way they managed supply. And there's a big, I mean, I saw about a year ago the big difference between production costs in the Middle East and, in the rest of the world, in places like Nigeria. I mean, everybody else is taking a bath right now. And the guys in the Middle East are continuing, as Clive is saying, to make a profit and make really, really good money. What's also interesting, actually, in terms of how we've been just, playing around with some graphs, is that relationship, because obviously oil is a commodity, something that people trade and play around with. And and the U.S. monetary policy itself played a huge role in terms of propping up oil prices, because people had all this excess cash, which they were playing around with, and they played with it in oil. They certainly played with it in gold. What is interesting now is that turnaround is because people are saying, well, what's going to happen next?
The house of cards is collapsing. Absolutely. In essence. And we're continuing our focus where we are navigating between what's happening on the South African domestic front in terms of the biggest macroeconomic stories, as well as the big international conversation that's happening coming on the back of the global sell-off currently underway. And still with me, Xhanti Payi, economist at Nascence Research and investment specialist at Clivera-Inc, Clive Ramathibela-Smith. Both gentlemen still here with me. Before we went to break, we were talking about the dip in the crude price. But if we start to look at stocks like Sasol, that we know are so exposed to the dynamics of the oil price, Clive, how do you even begin to play around in a market that has this much volatility? Or do you just hang 10? What do you do?
You can't hang 10 because you're going to, at some point, you'll drop. But here's a nice thing about Sasol that we know that late last year they changed their identity on the JSE. They decided that they're not a resource-based company, they are a chemicals-based, so they're going to the industrial space as opposed to the resources. I don't think that has helped because still most of the products that they produce, for example, are still pretty much predominantly reliant on the produce of oil, so Brent crude. So even though their revenues, 44% of their revenues is actually out of alternative products that come out of Brent crude, but still they are looked at as a commodity-based business. And so it's very difficult to remove that from investors because they don't like change. Investors don't like change. So this new concept of industrial business is still foreign to them. So they haven't got comfortable with them. And that's why even now, as we speak, the share price is still down by almost 10% for the year.
Investors don't like change, and I think when we also look at just the economy and the growth of the economy, we just have to keep on factoring the change because the forecasts for growth in the South African economy seem to be getting leaner and thinner. FNB coming out today saying that they're seeing the economy growing at 0.5%. I mean, at some point, somebody's just going to have to call this and say, well, there's going to be negative growth and a recession in South Africa.
Xhanti, they must give me that recipe for dieting because they keep getting thinner and thinner.
I mean, you know, and talk about thinner and thinner. Many companies actually kept getting thinner and thinner, you know, to stay profitable. And you know, and we were seeing this thing in terms of, you know, the stock exchange looking so great, but certainly the economy not going anywhere.
Yeah.
Obviously, job losses with cuts and all of that stuff. And this divergence has been a big problem, and many people obviously didn't focus on that because people are very interested in what it looks like in their portfolios and their bank accounts. But certainly that does come back to bite us all because suddenly people have to recognize where you draw your profits and how it works in the real economy. One of the interesting things also is around how monetary policy has played a role in this.
Yes.
People don't want to recognize that, you know, for the best part of what central banks are supposed to do, they're supposed to stabilize economies rather than do much of this new, I suppose, tradition of inflation targeting.
Yeah.
You know, the Americans did it successfully in terms of actually stabilizing and making sure that they did the right things. Here, we've been very, very stern in terms of saying we're going to manage inflation against everything that's been happening in the economy. So what
to do? I mean, we are supposedly in an upward interest rate cycle. We've seen the rise in interest rates by the Fed. Do we have any room to play?
I've got a controversial view when it comes to the South African Reserve Bank. I think it's far too independent and it doesn't take into consideration the rest of the country. And government has to strategically do something to drastically convince them that they are part of the economy as well, and they contribute heavily on what happens as an outcome to what happens in the productivity of the country. So the issue that he's just raised right now about inflation targeting, it's been tried and tested in other economies, but South Africa is a dynamic and unique economy. So you can't cut and copy and paste things that have worked elsewhere to try and
That's
and
very
mitigate
controversial.
risk.
I mean, I want to get your views on this, Xhanti, before we go to international programming, because when people talk about the attractiveness of investing in South Africa, one of the key things that are flagged is the independence of the central bank. So how do you react to what Clive is saying?
Look, I mean, the independence of the central bank is important, but they take that direction from the government. So what happens is this, that they're required to be, like most institutions in South Africa that are not in government, whether, you know, it's the prosecuting authorities or anything else that's supposed to be independent. So certainly, but, you know, the government has but they have to take some advice from the central bank as well to say, look, this is where we are, perhaps we should look at a different mandate. This mandate has to change. And also in terms of just managing the currency. One of the interesting things that, I mean, I think we've had this conversation before around managing the rand and its stability, this idea of how we have to find a creative way of doing that. Certainly this is not working in terms of sitting back and saying, well, we are only here for inflation, when we know know that the rand is one of the major, actually at the moment the central bank is mostly worried about the rand in terms of inflation. But then they say, oh, well, there's nothing we can do about it.
So we're going to come back to the currency conversation because I think it's very important. Let's cross over to international programming now, because we know earlier their statement came through that the Fed has made a mistake, and we've been talking about the role of the central bank in stabilization in South Africa. Let's pick up on the international conversation and we'll come back to the domestic front in a short while.
29th. That there's just not that much selling pressure left. I do think there's evidence. By the way, small cap stocks today not underperforming by very much at all, which does sort of show you the damage has been done in large part below the surface of these indexes, the big cap index.
It'll be interesting, Mike, given what you say about the fact that it's a 3-day weekend, whether there's a short covering that comes through this afternoon that lifts the indices from where we are at the moment. In the meantime, it seems to the point that you're making, the relentlessness, without a capitulation, the relentlessness day after day over the last 2 weeks in that selling. But not just that, within that, the rotation of the selling. So we started off with energy and China as a focus, and we've ended up now selling the financials quite heavily and consumer discretionary relatively heavily, and then tech within that. And I wonder what that says to you.
Yeah, you've had a localized commodity and then China growth scare that has really bled over into a much kind of broader based fear that global economic slowdown is not fully going to spare the United States. So that's really how that trade has moved in the way you set that up. Now, does that mean that the markets have it correct in the U.S. After a 1% or worse fourth quarter growth is going to stay at that pace in the first quarter? I don't know. Certainly the Treasury bond market is bracing for something like that. But to me, again, it's much more about a lot of these dominoes have already fallen before it got a lot of U.S. index investors' attention. And so that complicates the story of whether, in fact, we're sort of closer to the end of at least this phase of the down move or not.
And some of those quality names, Morgan Stanley down 18% so far this year, that arguably may be where you see the opportunity. Mike, no doubt we'll come back to you as we continue our markets coverage here on CNBC. Thank you very much. Mike Santoli.
Heavy losses still the key theme that's coming out of the global conversation that is currently underway. Let's bring it back to Johannesburg now. I promised that I wanted us to talk about the currency because that's been a bumpy start to the year. We did see weaknesses to the extent of 17.99, but the reaction by the ANC Youth League. Xhanti, let me start off with you. Does that make sense, or can you help us understand what the positioning is there?
Look, I mean, there's a general, what is the word? Maybe ignorance about markets in many of the political parts. So in terms of just saying what the reality of the situation is in terms of financial markets and the economy itself. You know, because of the fact that, you know, there's a lot of talk in the background about nefarious factors and all sorts of things that are happening. But if you were to actually sort of question them in terms of what it is that they mean, how they understand everything, then you find it's a little bit empty. So I think some of those things are sort of to be left alone. I tend to not pay too much attention.
Is this a credibility conversation that's now going to erupt around the ANC Youth League, especially around statements that Barclays is responsible for the sell-off in the rand?
Two things. Political schooling and how relevant that is, and the requirement for us to actually empower ourselves to know about financial markets and the response and the balance of the new world, the new era that we live in, and how sensitive politics can be in reactions to the markets. And that's the first thing. Secondly, if we go back to the old school, we're not going to get to know the new school, because the new school is the likes of Silicon Valley, where things, innovation and everything, creativity comes to light. And perhaps maybe it's a question we must, and this is me being very controversial again, maybe it's a time we do a introspection and see whether the policies that we are designing as a South Africa, as a nation, are perhaps maybe not the issues, the problems that create the slowdown in our economy. Is it possible that we need to be diversifying and moving away from the customary, the common law type of innovations that have been taking place in terms of creating jobs People today, jobs mean something totally different. Today, you don't have to be in the office to be doing jobs. There's other things. And I see this because I work very closely with South African local government authorities. I work very closely with local economic development. And the shift hasn't happened. We still think the ICT sector is the best thing for all our children to go into. And perhaps maybe it's a historical problem, and we have to address it. We need a psychological change, a shift in mindset that says empowerment, engagement, innovation, and move to that particular space before it's too late. Because we had how many matriculants? 300,000 odd that matriculated this year. What is going to happen to those people? What are we going to do with those? And if we still have the old mythology that has trapped us in thinking that there's some conspiracy behind banking sectors, there's some conspiracy behind financial markets, we're never going to be able to move forward.
I think Clive for president, and I might just vote Xhanti for deputy president. We can share deputy presidency, Xhanti. I think we can do that.